Okay, so our previous video was on question 3 of 2022 paper, in which we asked to prepare statement of cash flow. Yes, so we're going to proceed from here. We're going to section B, in which the first question, which is question 3, is asking us to prepare, to update the cash book, and also to prepare the statement of bank reconciliation, or rather bank reconciliation statement. Yes, from there we're going to prepare partnership accounts. Okay, yes, then we have question 4 there, and the last question, which is question 5. Okay, so we're going to proceed. So in the following information, we've been given information on the previous cash book that was prepared, in the bank statement which was prepared, which were having different balances. Remember, bank reconciliation statement is only prepared in order to reconcile the balances. It's a situation where if the bank reconciliation balance, let me say bank statement balance, and also the cash book balance are different, someone is required to prepare bank reconciliation in order to make the balances be the same. So in our case, there were some errors which occurred that made the balances of the updated cash book and that of the bank statement not to be the same. So we're going to update the cash book. From there, we're going to proceed to prepare the bank reconciliation statement. So in our case, this is question 3 2022. They're saying on 30 June 2021, Cook's cash book showed that he had an overdraft of 300 on his current account. He had an overdraft of 300, and on overdraft, which means you had withdrawn more than what you have in your account. So this person is having a credit balance in the bank. So we're going to start with that information as our credit balance in the updated cash book. So first things first, we're going to prepare our updated cash book or revised cash book or redrafted cash book, whatever you may call it. So first thing, we've already read information that this person is having an overdraft, which means he is having a credit balance. So the balance brought down is going to appear on the credit side. Okay, we can write the details here, in which you have receipts on the debit side and payments on the credit side. So since this person is having a credit balance, so our balance brought down is going to be, they said the overdraft was 300. Okay, so the balance brought down is going to be 300, which is a credit balance. Then they're saying a bank statement was at the end of the 20th of 2021 showed that Cook was in credit the bank by 65. So in this case, the bank is indicating that this person is having a balance of 65, yet the cash book is saying this person is having a balance of 300, which means if the balances are different, we have to find what were the mistakes, what happened, so much that everything that we're going to do was supposed to arrive at this 65, because bank statement is always assumed to be correct. The mistakes are made by human beings when prepare the cash book, but with the bank is always assumed to be correct. You can't go to the bank and withdraw a 300, then you'll be given a 3,000, or you withdraw a 4,000 and maybe you are not going to get a 100 kwacha. No, the amount that you're going to indicate is what you're going to collect. Okay, the amount that you're going to press is what you're going to collect. So the bank is always assumed to be correct. So everything that we are doing are supposed to arrive at the same balances. Okay, so we have a credit balance of 300 kwacha, and this is the balance in the bank statement which we're supposed to find. Okay, so going in the question, they're saying on first adjustment, which is C, checks drawn amounting to 500 had been entered in the cash book but not been presented. So we know that that is unpresented checks. Unpresented checks are never part of the updated cash book. Next, checks received amounting to 400 had been entered in the cash book but had not been credited. We know that that is uncredited checks, and uncredited checks also are not part of the cash book. Those are information in the bank reconciliation statement. We don't need that. Okay, next, on instruction from Cook, the bank had transferred interest received on deposit account amounting to 60 to his current account. They're saying on instruction from Cook, the bank had transferred interest received on his deposit account amounting to 60 to his current account, recording the transfer on 5th July 2021. This amount had, however, been credited in the cash book as on 30 June 2021, which simply means this is an instruction. Cook was supposed to receive interest, and we know that when he receives interest, here we have two types of interest: there's interest received and interest paid. When you get a loan, the interest that you're going to pay on the loan is what we call interest paid, which is supposed to be a credit balance, but this one is supposed to be a debit balance because it was interest that was received. For instance, if you put money in a fixed account, you're going to get money with an interest, the same money that you had kept, but it's going to be an interest, which is that one is coming to you, which is an interest received, which is a debit entity. So debit entry. So in this case, you're saying this entry was recorded on 30 June, but the transfer occurred on 5th July. They entered it already. So it simply means this current account had recording the transfer on 5th July. This amount had ever been credited in the cash book. They have credited it in the cash book as on 30 June. They have credited. This is interest received. This interest is coming, interest received, like as indicated, interest received, but what they did was they credited it. So in order to correct that, you know that that's a debit entry, we're going to debit it. And since they already credited it as a 60, if you write a 60, that 60 it's already been written as a 60 side in the previous cash book. So if you write a 60 here, that entry is going to cancel itself. So in order to avoid that, we're going to double the amount and write it to the side that was supposed to be long. So in this case, we're going to write our interest received here. Interest received to be, we're going to double the amount, which is going to give us a 120. Because it was, let me put an example here. If an entity, like in that case, that entry was supposed to be on this side. So if we just put a 60 this side, which means it's going to cancel this, we're going to remain with nothing. So in order to correct this entry, which was supposed to be this side, but we've written that side, we're going to double the amount so much that we're going to have another 60 here. So if we correct this, balance carry down is going to be 60 because that one is going to cancel with that one here. That's what we have done that side. Okay. So next, we have instruction F, in which they're saying bank charges 35 shown in the bank statement had been entered in the cash book had not been entered in the cash book. Bank charges, these are charges that a current account holder suffers. For the bank to render their services to you, you have to pay some charges. Even just checking your account, in some banks, they're supposed to get something. So now they're saying this was not entered in the cash book, and since these bank charges they go out of someone's account, it's a person who pays. You won't receive those charges. No, it's you they're charging. So it's a credit entry. Since it was not entered, we're going to enter it. Bank charges, it is always a credit entry amounting to bank charges 35. Okay, next, the payment side of the cash book had been undercast. Undercast means they have written lesser than what was supposed to be there. It was supposed to be 50, you write a 40, that is an undercast. If it was 80, you write a 90, that is an overcast. But this one, it was an undercast. So there's a shortage of, then you can still write it as undercast of 10. Okay. Next, the dividend received amounting 200 had been paid directly to the bank and not entered in the cash book. This dividend, this person was working for a particular company in order for him to receive the dividends. So now they said these dividends were entered direct into the bank and not entered in the cash book. So these dividends were not appearing in the cash book. So we're just entering them in the cash book. And these dividends are things that we're receiving. And remember, everything that we're receiving is coming on the debit side. So dividends received is always a debit entry. How much were the dividends? 200. The dividends were 200. Okay, next. A check for 50 drawn on deposit account had been entered in the cash book was drawn on current account. This check was drawn on deposit account, but they're drawn it as this check was drawn on deposit account, not this current account that we're preparing. So in order for us to remove it from the current account, we are going to debit it. Remember, it was drawn, which means it was on the credit in the other cash book, which is not supposed to be there. We're going to debit it. So we can just write this as any check of 50 kwacha. We've removed it. The next, a check is issued to Jones for 25, was replaced on out of date. It was entered again in the cash book. No other entry being made. Both checks were were included in the total of unpresented checks. They're saying this 25 was included in the total of unpresented checks. So they recorded it twice. They're saying a check issued to Jones for 25 was replaced on out of date. It was replaced on out of date. Now what they did, it was entered again in the cash book. Again in the cash book, no other entry being made. Both checks were included in the total of unpresented checks. So we should know that this check was entered twice and it is appearing in the unpresented checks, which means we're supposed to go there and remove it. We'll do that when we reach the other side. Okay. So this check was entered twice. It was issued to Jones. Now they entered it again. It was issued as out of date, but what they did was they entered it again. So we're supposed to remove it. In order for us to remove it, okay, we can rewrite this as our check A. This is our check B. So we are removing the check, so we'll debit it so much that since it was issued out, which means that check was going, cash was going through bank. So we're going to debit it like that. Then we are done with every information that we need here. So we're going to balance this up. So on the debit side of 120 plus 200 plus 50 plus 25, which is giving us a 395. 39, this is 325, 345. Okay, so we have a 395, which is the bigger balances. So this is the balance that we're going to use on both sides. Then 395 minus 35 minus 10 minus 300. So we have a balance carried down of 50. Okay, we have a balance carried down of 50. So coming down to the bank reconciliation, you can start with the balance as per bank statement or with the balance as per updated cash book, whichever that you are good at, whichever that you are very familiar with, but it still means the same thing. So in your case, we can start with the update balance as per updated cash book, or okay, we can start with the balance as per bank statement. So the balance as per bank statement, if you remember well in the question, they said the balance was a 65, so it's a 65, and you know that since this is a credit balance, we are going to add our uncredited checks. This is because we've started with the balance as per bank statement. If we started with the balance as per updated cash book, we're supposed to add unpresented checks. So balance as per bank statement is 65. We're going to add our uncredited checks. Uncredited checks in the question were in the second part, which they said check received amounting to 400 had been entered in the cash but had been not credited. That is uncredited, which is a 400. But we should not forget that there was this check, check E, in which they said on instruction from Cook, the bank had transferred interest received on his deposit account amounting to 60 to his current account. So this check was already deposited on his current account. So which means this check was supposed to be entered in his deposit account. Let's read again. On instruction from Cook, the interest received was transferred interest received on his deposit account amounting to 60 to his current account. Recording the transfer was on this amount however been credited in the cash book as on 30th June 2021. So they entered this on 30th June 2021. The transfer occurred on 5th July. So he received interest. That's why we had entered it in on the debit side of the updated cash book. But this amount wasn't credited in his account, because we entered it now by putting in the debit side. So it is us now who are entering this, which means this check was not credited in his account. It did not appear. That's why he did not even write it in his cash book. So we are going to add it to our uncredited check since it was also not credited. So we're going to add it to our credited checks, which is going to give us a 460. So if we add that 65 plus 460, about 525. 525, we're going to list our unpresented checks. Unpresented checks. And our unpresented checks, if you remember very well, According to the question, there's a 500 there, but we had that check which was not presented, that one which was issued to Jones, which I said you're supposed to remove it from an unpresented checks. They're saying this figure, it was entered twice and it was included in the presented checks, the last statement. So we're going to remove it from the unpresented checks because it was entered twice. So we're going to remain with 475. So if we do that, minus 475, we have the balance of 50. This is our balance as per cash book or updated cash book. Which is the value that we had found there, which simply means everything that we have done here is simply correct. Okay, so we are done with the first part of section B, question 3. We are going to the second part, in which we are asked to prepare the statement of profit and loss, appropriation account, as well as the partner's current accounts. Okay, so I think we can prepare the statement of profit and loss appropriation account just here, so that we save some space. Okay, so is this enough? Is this space enough? No. Okay, we can take it on the other side. We can take it on the other side. Okay, we can bring it here. We can bring it here. All right, thank you. Okay, so now this is partnership account. We've been given information on the, okay, they're saying more Mazuba and Mutinda set up a partnership business, sharing profits and losses in the ratio of 4:3 respectively. Under their partnership agreement, the partners are entitled to 5% per annum interest on capital, and interest is shared on the drawings at 6% per annum. As Mutinda has more operational responsibilities, she's entitled to a salary of 550,000 per annum. Interest is not calculated on the partner's current account balances. The partners accounting period ends on 31st March 2022, and the following transaction took place during the year under review. So we have that information there, what happened. Then on the last part, they are saying, being the first day of trading, there was no balance on the years on current accounts. Okay, at the beginning of the period. Then adjustment 4, it is saying the partner's business made profit for the year ended 31st March 2022, amounting to 350,000. Okay, 350,000. Okay, so that is the first information that we need. So this is our profit and loss appropriation account. Okay, okay, so we're going to start with the net profit. The first thing to appear is our net profit. In some questions, you're going to be given enough information which will require you to prepare statement of profit and loss account, in which we are going to find the net profit yourself. But in this case, we've been given the net profit already to be 350,500. Okay, so our net profit has already been calculated for us. If we're supposed to calculate it, we're supposed to start with our sales, do everything that is needed under profit and loss, then we go to the last part, which was supposed to give us the net profit. But in this case, our net profit has already been calculated for us. So our net profit, they're saying it was 350,500. Okay, then we know that this is appropriation account, which is totally different from the income statement. So we're going to do what we're supposed to do. So first thing, we're supposed to add our interest on drawings. Add interest on drawings. Since we have two partners, we have Muzuba and Mutinda. So interest on drawings, they're saying and interest is charged on the drawings at 6% per annum. 6% per annum, that is interest on drawings. 6% times this, so 6%, this is the interest charged on their drawings. So we're going to drawings. What is the information do you have on drawings? So they said drawings. Okay, so on 1st October, Mazuba and Mutinda made drawings of 80,000, this 100,000. So this one is 80,000. So 6% on 80,000. 80,000. We have 4,800. So this one is 4,800. Then Mutinda is also 6%. So 6 divided by 100 times 100,000. So we have 6,000. And we know that it is only interest on drawings which is added to the net profit. So we're just going to get the total of these two. Okay, there's nothing else that was supposed to be added to the net profit except interest on drawings. So if we add these two, this 6 will go, this is going to be 10. This is for 800. So this is 10,800, 10,800. So if we add 10,800 plus our 350, 500, we have 361, 300, 361, 300. Okay, 361, 300. Okay, next we're going to list our appropriations. Less appropriations. On appropriations, we know that we have interest on capital as well as salaries. Interest on capital as well as salaries, partner salaries. So interest on capital, we have that of Muzuba and Mutinda. Okay, so on Muzuba, the question was saying, under the partners agreement, the partners are entitled to 5% per annum interest on capital. So interest on capital is 5%. So 5 divided by 100 times the capital. In this case, they said Muzuba's capital contribution on 1st April was 600,000, and a further 250 was introduced on 1st July 2021. Okay, so for Muzuba, we know that there's a 600 and a 250,000. 600 and a 250,000. So 600 plus 250,000. This is 850,000. So times 6, was it 6 or 5? 5, okay. Times 5 divided by 100. This is a 42,500. From Zoa, it is 42,500. We've been given as the interest on capital to be 5%. So 5% is, well, since this person contracted at the start of the business, he contributed a 600,000. At the end, he contributed a 250,000. So we've added the 2, then the 5% on the total, which is giving a start figure there. That was from Zuba. For Mutinda, they said Mutinda on the other hand, Mutinda's capital contribution was introduced into the business on 1st October, amounting to 400,000. So Mutinda, it was just 400,000. So 5% on 400,000. 400,000. We have a 20,000. We have a 20,000 as the interest on capital, in which the percent has already been given. So this is going to be a 620. This is a 5, sorry, 62500. Okay. Okay, yes. So that was interest on capital. Next, we are supposed to remove their salaries. So on salaries, Salaries, what is the information? Mzua as well as Mutinda. Okay, on salaries, okay, here, as Mutinda has more operational responsibilities, she is entitled to a salary of 50,000. This is not calculated in the partner's current account balances. So in this case, we only have one partner who is receiving the salary of 50,000, which is Mutinda. Mzua doesn't have a salary, so Mutinda is receiving a 50,000. So 50,000. So we have 62,500 on top plus 50,000. This is a 112. This is 112,500. And since we are supposed to list the appropriations, we're going to put it in brackets to indicate subtraction. So that figure, we are removing it from this 361, 300. So this is 248,800. Do it again, 361, 300 minus 112,500, 248,800. Okay, that is our what we call the valuation profit. Okay, and now moving forward, we have to find our share of profit. So share of profit, we've been given information saying okay, so share of profit, the question itself is giving us instruction saying Muzue and Mutinda just set up a partnership business sharing profits and losses in the ratio of 4 to 3. So share of profits, we have from Mzua and then Mutinda. So 4 to 3. In this case, they're saying 4 to 3, that is Muzua and Mutinda. Okay, so since Muzua is the first name, so 4 to 3, the total of this is 4 plus 3, which is 7. So for Mutinda, the first person is going to be 4 over 7 because he's the first person, so he's representing the first number, which is 4 over total number of the ratios, which is 7. So that figure times the 248,800. So 4 divided by 7, we have that figure times the 248,800, which is giving us a 142,171 points. Figures down. Okay, that was for Muzua. Mutinda, so it is saying 3, 4 to 3. So the 3 is representing Mutinda. So 3 out of 7 over the same amount, 248. This amount here, 248,800. So for Mutinda, it is 3 divided by 7. So that figure times the 248,800. We have 10. This one we can indicate lines. We have 106.628. So we can get one from there. Since this one is 5, you can get one from there to be 0.9. When you add these two, this one plus the 142,171, we have the same figure which is there, on which if we get the one here, it's going to change to 0. The 0 put it there, then one will go outside, it's going to be 248,800, which is that figure which is on top, 248,800. So we are done with the partners profit and loss appropriation account. Next, we are supposed to pay the partners current accounts. Okay, so on their current accounts, I think you can just use one table. You can do this separately, but in this case we're going to use one table so that everything is going to fit this side. So this is our debit side, this is our credit side. And since we have two partners, we're going to do this So this is our debit, of course. This is our credit. And then this is Muzuba. This is Mutinda. This is Muzuba. This is Mutinda. Okay, thank you. So this is our debit side. This line is separating the difference between the debit and the credit side. Okay, so on the debit side we have Muzuba in Mutinda. On the credit side we have Muzuba Mutinda. That simply means this is the debit side of Muzuba alone, and this is the credit side of Muzuba. This is the debit side of Mutinda. This is the credit side of Mutinda. But you can do this separately, in which you are going to prepare two accounts. Yes. Okay, so in the two accounts now, this is the partner's current account. So they're saying this is the first year business, which means this there is no balances on the current accounts. If you had the balances, are supposed to appear on the credit side. Sometimes the balances on the debit side, depending on the question. But if it's on the debit side, the question is going to indicate that for you. Yes. So we're going to start with our, on the debit side, we have things like drawings itself and interest on drawings. That's all. We have drawings and interest on drawings. That's all. In some cases, yes, if we have the partners were sharing a loss, yes, it's going to come here as well. But if they were sharing profit on the debit side, we just have drawings and interest on drawings. And also, if the partner's balances was a debit balance, yes, it will come on the debit side. But usually, it's drawings and interest on drawings. So this side, that's where everything belongs. Things like interest on capital. Interest on capital, remember in the question itself, Muzuba, it was 42,500. Then Mutinda, it was 20,000. Then we have salaries itself. Remember, it was only Mutinda who was entitled to a salary of 50,000 in the question. Yes, it was only Mutinda had a salary of 50,000. So Muzuba, there is no salary to come here as well. Also, share of profits comes here. So share of profits, Muzuba, it was 171. This one was 106,629. Then what else do we need here? So that's on the credit side. If we had also interest on loan, it was supposed to come that side, but in this case we don't have. Then the drawings part, I said drawings are found here. Drawings, Muzuba, it was Muzuba information on drawings. They said drawings of 80,000. This one is 80. This one is 80,000. Then the other one is 100,000. Then interest on drawings. Interest on drawings, we already calculated that. This one was 48. The other one was 6,000. Okay, that's all that we need in the current account. So we're just going to balance these things up. So if you balance this up, so let's try on the credit side, which is seeming to have a lot of numbers. So we have a 20,000 plus 50,000 plus 106,629. This is giving us 176. Can you take all this side? No. So this is the biggest side. So we have 176,629. Which is the figure which is going to come here. That is just from Tinta 629. Okay, when you get that figure, we subtract what is on the debit, which is a 6,000 only, and the 10,000. We have the balance to be 166,629. Okay, that was from Tinta. From Zuba also, I don't know which side seems to be. This is 80 and the 4. This is 142. No, this side seems to be big as well. So we have 142, 171 plus 42500. This is giving us 184,671, 184,671 as well. When you subtract this figure minus this two, which is 80,000, minus 4800, sorry, it was 184,671 minus 80,000 minus 4800, we have 99871. So for the next year now, when they'll be going to prepare the statement of profit and loss, or let me say when they prepare the current account, these are the balances that they are going to start with, which were the balance is supposed to begin with here, and it's only that the business has just operated for a year. So that is all for our current account. So let me say that's all for our question 4.